I know that you like to look at things in terms of the Nadex platform. There's something happening at 10:30 today?
That's right. We like our Wednesdays. We like news action. And, of course, Wednesdays, we're going to have EIA inventories come out every Wednesday, 10:30 a.m. Eastern Time. So let's jump over. We'll take a look real quick. So every Wednesday, 10:30 a.m. Eastern Time, you have the EIA inventory numbers on crude. Of course, as those inventory numbers are released, you can get some action in the crude market. I have the March futures contract up currently right now, trading 64.37. So the numbers come out at 10:30. Right now, it's literally almost 10:20 on the dot. So we got 10 minutes until those numbers come out. And what I've done first is I've pulled up the 11 a.m. spreads, okay? So I go into commodity spreads. I go into crude oil. I'm going to start off with the 11 a.m.s. And ideally, what we're looking here for usually, Basil, is a volatility trade, okay? So we're looking to take both sides of the market and see what kind of premium they're going to be charging us for both sides of that market, so that you're looking for a bigger, you're looking for a move in either direction, right?
So can I give you the numbers? I'm looking at 64.19 as the base of support that it has to hold, and I'm looking at 64.50 as a spike to the upside potential.
So right now you have spreads that line up somewhat decently well. You have the underlying contract trading at 64.36, and you have spreads that have a point of 64.25. So only about 10 pennies away from where that is trading currently, which could be your floor and your ceiling. So for the bullish trade, you have a spread going from 64.25 up to 65.75, $1.50. Now in that spread, you're going to have intrinsic value, right? Because you have 64.25 is where you start getting value. The current contract is trading at about 64.33 now as it jumps around. So you're going to have about 8 pennies of value. So this is going to be the more expensive spread of them. So right now you'd be paying about $20 or 20 cents for that contract, because you're buying it at 64.44. The floor is 64.25, so 19 there. And then the bearish one is going to be all premium, because you have no intrinsic value. This has value starting at 64.25 down to 62.75. So for this one, you'd be selling it, and you'd be selling it at 64.14, which is 11 pennies below the ceiling of that spread, so about $11. So you're looking at $30 for both of those spreads, which would represent 30 pennies of movement you would need away from that 64.25 price point before you start to break even. So to put that, that would either be 63.90 to the downside or 64.55 to the upside. Now, just to bring it in, the reason why this could be a little bit of a bullish trade is because you see that you only need to trade 20 cents to the upside to get your break even. We're trading right now at 64.35, whereas to the downside, you need to trade 40 cents to the downside. Now, you don't need to hold these till 11 a.m., of course. You can trade these out. If you get a spike 10 minutes, sometimes you get a spike within 60 seconds after that.
Well, that's what I'm thinking. Yeah. Right. It goes both ways, and one of them is much sharper than the other.
Yes, for sure. Now, that is the 11 a.m.s. What we like to do is we like to jump around and see, let's say you want a little bit more time in your trade, right? Let's say that you want to let this play out until maybe noon or potentially even 2:30 when the futures closes on crude. So let's jump over to the 12 o'clocks. Now the 12 o'clocks, I've already kind of jumped into them. They line up a little bit differently because they get set when these open. And so the price of crude, as you can see, has had some volatility already this morning, was below $64 at about 7:30 this morning, up at 64.35. So these are going to have a point of 64.50, okay? So where that changes things is, instead of having a little bit of intrinsic value to the upside, which you had in the 11 o'clocks, right? You're going to have a little bit of intrinsic value actually on the downside. Exactly. So that's an intriguing, look, where if you were a little bullish or a little bearish, you could shift what trade you wanted to make. Now, keeping in mind, though, that one's at 11 a.m. and one's at 12. So on this one, again, 64.35 is where oil's going to be trading. So on your bearish spread trade, going from 64.50 down to 63, that's going to be where your intrinsic value is now, about 15 pennies. You'd be selling that contract. So that is going to be the more expensive spread this time for 29. And then the bullish one is just going to be all premium, because you are about 15 pennies out of the money, you could call it, before you get any value, up to 64.50. And that one's going to be costing you 13. So the 11 a.m. spread with 64.25 was going to cost us about $30 for both of them. The 12 o'clock spread with 64.50 kind of being our pivot point. It looks like it's going to cost us about $42, which would represent 42 cents of movement you would need away from that 64.50 point before you broke even. So, and that's where you get to decide, right, whether you're market bias, whether your expectation, and we trade this all the time, and boy, sometimes the first move is not always the move that matters on this.
Well, that's the thing. I've noticed that with the crude oil especially, that it could, in fact, dive down to the 64.05 area.
Okay.
And 10 minutes later, you could be looking at 64.47.
Yes, and you can always trade out of one of those positions, keep the other one open. You know, there's a lot of ways to trade that.
Is it possible to have a trade that says you put in a price, you can exit at 64.19?
You can always put in your bids and offers ahead of time. You know, the nice thing about trading on the Nadex platform is you can be the market. You see the bid, you see the offer, so you can put those in ahead of time for sure. If you're looking...
Would it allow you to still have a position that would be long, that if it rallied?
Yes, and that would be where you would, so for the example you're talking about, let's say, you would, here is your bearish spread on the left. You have 64.50 down to 63. You could put a bid in there, right? Let's call it, you know, and the one thing you want to take into consideration, though, is that there's going to be some premium priced in here. So if oil trades to 64.19, you may see a slightly different bid offer, you know, as this is trading, because the spread is going from 63 up to 64.50. There may be a little bit of premium priced into that. So even if the underlying is at 64.19, there may be a little bit of a shift, but you could easily, just for simplicity, 64.19, you put that bid in, you become that, and that's where, you see, and the reason why I stress it is because even right now, the current live bid is 64.22. But you can have that bid in ahead of time, and that's actually a good idea, because if anybody's watched the program, sometimes the spike is as short-lived as 3 seconds, right? I mean, so you really do want, on a news event like this, to have those orders in ahead of time. Yeah.
Right, so that you would take it off at that level.
Yes.
Keep it and try to hold it to the upside.
And that's why you would still have your bullish position. You know, you would still have your bullish spread, and you'd have profit potential up to $66. Okay, folks, come on back. It is 10:27. Those numbers get released right at 10:30. We'll be back in 3 minutes for the EIA oil numbers. Welcome back, everybody. Tommy O'Brien with Basil Chapman. So, Basil, the numbers are out. We'll get into them in a moment, but we see oil jumping around to jump over in the chart. So it looks like oil trading a little bit lower. We were approaching 64.35 prior to the news announcement at 10:30. We saw it trade a little bit lower. Just as the numbers came out, we saw the spike lower, currently trading 64.14. So we're about 20 pennies lower than we were looking at, and we'll see where that shakes out. I know the estimate they were looking for was about 126,000 barrels of surplus, and as we get into those numbers, we'll see where they shake out. But again, we're only about a minute into the news announcement. We were looking at the 11 a.m.s, we were looking at the 12 o'clocks, and to put things in context, I still have the 12 o'clocks up. This would have been our bullish spread from 64.50 up to 66. That, of course, is now severely out of the money as we're 40 pennies below that. But the bearish spread would be where you have all your value, right? We're from 64.50 down to 63. And that is the one as we continue to trade lower. If you wanted to trade out of that, that was up. And now as we speak, almost approaching 64. That was going to cost us about 42 pennies. $42, excuse me, for both of these contracts. You would have needed 42 pennies away from 64.50 to break even, and already we're approaching about 50 pennies. So you could have a profitable position if you wanted to exit that right now, buying that bearish spread back at 64.02. This spread, though, to kind of illustrate your example, would still be live. So if you were to get a bounce from this level, that is a live position where you have profit potential up until noon. Now, it hasn't turned around yet, but again, we're only about 100 seconds into the news announcement, and we're at 10:32, and you have live action until about 12 o'clock.
All right, so I'm going to stick with that thesis that we would exit on a sharp pullback and let the bullish position run until 11 o'clock and see what happens.
Yeah, you can't go wrong. You know, I mean, you'd have a small profitable position. As in, you're getting out at about $64, so you'd be getting out at about $50. Even with commissions, you'd be making $6, $7 per contract that you had for each one, risking about $42 for that trade. And with that, you're only 50 cents away from any type of value for your positive spread with 90 minutes, call it 87 minutes of option capability there.
Very good. And of course, I'm behind. Funny, I was exactly with you earlier on, but with the speed that it's trading now, mine's behind.
It's great. We always say the Nadex platform, live quotes, get over there, folks. Get a demo account, test it out, because it is, whether Tom's using the Bloomberg, whatever it be. And just so the number was 6.7 million barrels. So that is quite a surplus. 6.7 million barrels.
Huge.
The estimate was for a forecast of 126,000 barrels. More supply equals lower prices, folks, and that is the cause of that, and it's not stopping. 63.94 as we speak. And so on this trade, you would have profit potential all the way down to $63, looking for that 12 o'clock close. Welcome back, everybody. Tommy O'Brien, joined with our man Basil Chapman. And Basil, just to check back in on the oil contract, because, man, it is quite an illustration of what we talked about. So we had the rise of 6.8 million barrels, much more than the forecast. Oil spikes down from about 64.30 down to below, let's see what the low was. We had it about 63.93. These are 5-minute bars that we're looking at. And the next bar spikes all the way up to 64.44. Pretty cool. That's what we're talking about. So even though it didn't get into the area above 64.50, which would be where you begin to get value on that positive spread, kind of the methodology that you had talked about, selling that down at that level, you still would have your positive trade for any type of action above 64.50. You get value. And again, we're only 13 minutes into the news event, came out at 10:30, and you would have that profit potential all the way till noon. And it's cool we got the bar, because it just kind of illustrates the type of market activity you can get, and that the first move is not always the move that carries it throughout the remaining part of the day.
And you can see on my delay chart, I'm still going down. Right now, we're going down to the level
That's pretty cool. Yep. Right.
It's really interesting, isn't it?
It is. It is. And that's, if you follow it, and that's, if you're going to trade these, you want to be following it, right? Because you want to be at least familiar with the type of moves you can get, because, man, that would be a really shocking move when you get the move down. You have the numbers in line with you in terms of how does that spike 50 cents from there. It was even above. It was trading at 64.35 prior to the news. You have a build of 6.8 million barrels. The forecast was barely over break even, as in the forecast was about 100.
So that's not a good thing. So you wonder why it goes down and then bounces.
You got buyers, right? You got buyers no matter what. You got somebody. And so right now the contract's trading at 64.26. And again, we'll check in one more time towards the end of the hour and see where it trades. But pretty cool, for sure.
Very interesting.
Welcome back, everybody. And to jump back into the crude oil market for one final time as we wrap up the hour, 10:54. And we're about 25 minutes after the news announcement, currently trading at 64.14. So just kind of a good illustration. Here's our 10:30 bar, spikes down below 64. Man, spikes all the way back up, good 50, 60 cents, almost to that 64.50 point. And from there, we trailed back a little bit, 64.17. And again, if we were trading those 12 o'clocks, you would still have profit potential up till the noon Eastern time price point. Pretty cool.